Okay, alright. Welcome back to the Make Lemonade podcast, the show for creators by creators, where we hope to inspire others to earn money from their own lemonade stand. I'm one of your co-hosts, James, and I'm back here with JR Farr, co-founder of Lemon Squeezy. Now, if you knew you were going to sign a piece of paper that was going to make your company worth $50 million, would you turn it down and walk away? Well, that's exactly what happened with JR and the Lemon Squeezy team, and it's actually why we've had a brief break from the podcast. But we're back and JR is ready to share all. We've lined up a cracking few episodes for this series of the show, including talking about walking away from the money, how shipping works at Lemon Squeezy, and some of the mental health challenges that have come along with building a startup, and a few special guest appearances along the way. In this episode, we're going to be unpacking the process of raising Series A funding. What are the things they don't tell you? How long does it take to do? Do you have to go to San Francisco? And ultimately making the big decision to turn down a life-changing raise. Let's get into this episode. JR, welcome back. Good to see you. Maybe you can fill us in on what's been happening since we recorded our last episode a few months ago.
Yeah, I mean, let's actually think. So our last episode that we released was like April. And it's the timing is, now that I've just said it out loud, I realize that this episode that we're about to record around, funding and, Series A and all this stuff, that's literally when it happened. That was the time. I think I was actually in San Francisco and like doing all that. And it's a complete time suck. It's chaos, right? You have no time for anything else. And so I don't even think it was intentional. I think it was just drowning, right? So we had the growth, we had the funding, and then it just wasn't room for anything else, right? Because I've always really loved this podcast. And obviously, I just spent a bunch of money and time with you trying to get this to look better and more organized. But yeah, I'm excited though. I'm excited for I guess we'll call this season 3.
Yep, season 3. And you come up with some killer topics for the next few episodes, and I'm quickly going to run through what we've got coming up. So this episode is talking about turning down the Series A and that big valuation that you had. The next episode is going to be all about shipping, how you ship fast and effectively at Lemon Squeezy. The third episode, we've got a guest, which is going to be San Francisco, who's just an awesome guy. I've had him on my pod before. Episode 4, we're going to do you've put here the mental side of startups. Do you mean sort of the actual mental health side of startups and what's going on at Lemon Squeezy?
Yeah, it's like the mental warfare. It ranges from, burnout to imposter syndrome to overthinking to, as the company evolves, like in seasons almost, right? Like, you're trying to get started, you're trying to get the team, you're trying to make your first hire, you're trying to, right? Like to land your first biggest client. Like you're trying to do all these things. And I just think that there's a mental side to all of it and how to stay motivated, how to keep the team motivated, how to keep yourself. Yeah. Like I've just gone through a lot of that stuff. And I think a lot of people do. And I do think it's becoming more of a common thing to talk about, and I'm not trying to get like super deep with it or anything. I just think that what we do as entrepreneurs is really hard. And I think it's good maybe sometimes for people to hear like, oh, from the outside, right? Like Lemon Squeezy probably looks like we have our shit together, right? But we're just human too, right? And there's days where there's better days and there's days where there's bad days and tough days, right? And I think that's normal.
Yeah, I agree wholeheartedly with that. And I've had my own mental health experiences and I've shared a lot of that. So I'm keen to discuss sort of your take on it. Okay, so that's what we've got coming up over the next few episodes. Do you want to kick us off with what's been happening? It seemed like raising for you was the obvious next step after all the traction you were getting.
Yeah. So let's actually set the stage. So let's go back to when, obviously with my background, I've started lots of companies, I've sold, had some wins. And so, yeah, when this time came around with getting back on the horse and doing the whole rodeo, getting back in the arena, right? Is what I like to kind of say. I think the intention was always and is still that let's think about this company in decades and how do we exist for the long haul and how do we do that? And obviously, I'm a big fan of bootstrapping. I'm not against funding. There's certain companies that require it. When I sold my last company, we were late stage private equity, right? Goldman Sachs, Warburg Pincus, that kind of thing. There's a different type of pressure or requirement that's over you, right? Once you take that money, the game changes. You're on a different field now. And so when we first set out to build the company, it was very much like small team, high impact, controllers of our own destiny, profit sharing for the team, and then something that can exist for 10, maybe even 20 years, maybe even longer in this world, which is like another way to think about how to tackle a company and build it. And so we were really, really adamant in the beginning that that's how we wanted to kind of build the team. And then obviously as you get into this like fire hydrant growth where you're drinking out of a fire hydrant, right? A lot of this inbound interest started to happen, and more so than it was in the beginning, like where you're getting the brand names reaching out and partners, general partners, right? Of the big names, the A16Z, Sequoia, Excel, the big daddies, right? And it's flattering. It feels good. And so we just kind of started to have these conversations, and one thing, just leads to another, right? Like then you kind of get your deck built, and then you start doing your pitches, and then you start talking to other founders that have raised, and they kind of tell you about their cycle that they run and how they do it. And, I've always tried to be transparent. Like there's a game to it where when you raise, where you're playing people against, once you get a term sheet, then you go and get more, and then you do this, and then you get these angels involved and strategics, and it's just a game. Right. And also too, we had a team, right? And the team their lives were going to change, not just ours. So it was a big decision, I guess what I'm saying. So I was just setting the stage of like, we started out this way with this intention, the inbound interest comes, the big brand names come, we start having the conversations, and then it's like, you just get like caught up in all the minutia, right? And that's where the time suck comes in. And in this episode, I really, really want to talk about the process. Because I remember thinking this, like, okay, I just had my first pitch, and now I'm going to meet the partners, and then now I'm going out to San Francisco, and I'm doing in-person partner pitches. Like, I always was Googling, like, how long does it normally take to hear back? How long does it normally take to, you know what I mean? Like, you kind of, there's this expectation thing, and so I think I can help people, like, maybe uncover some things that are maybe a little bit like mysterious about the process to get to a term sheet, especially for a Series A. And then, one last caveat this is probably the most important thing. This is March and April of 2023, which is arguably one of the worst times in the last 20 years, right, to raise money because of everything that had been going on, right? We're seeing it now where there's some slaughters happening to some companies that took a lot of money and big valuations, and that was kind of the heyday of after COVID, right, was to take all that money. And so definitely a bit of a different time. But I think, well, first of all, let's talk about the different types of raises. I think that's important. What is a Series A? Why is that, and what is that, and a B and a C, or the pre-seed and the seed. So seed rounds, I think obviously the numbers, the size of the checks, and the valuations have gone down because of what happened in 21 and 22, right? So typically the seed is you've got an idea, maybe you have a prototype, maybe even have a few customers, and you want to go raise, a couple $1,000,000, right? It's usually done in a convertible note. You don't want to price that round, because if you price that round, when I say that, by the way, I don't want to say these things like everyone knows what I'm talking about. A convertible note is a really simple way to basically push down the price round down the road. So if and when that happens on the next round, those notes will convert at the new round price. Does that make sense?
Well, what's a price round? What does that mean?
A price round means so when someone says a Series A and it says, we're going to raise, 17 million and the post-money valuation is 70, right? Or 60 or something. That is where the round has been priced. So on a seed round, that's not going on. They're just, we've now, we've got funding for $4 million in a seed round from a convertible note. And they're usually caps and valuations and discounts to the investors. So when there is a price round, they get these better terms because they invested sooner. So the caps and the discounts activate when that note converts to the price round. But, as you get into the Series A, there's definitely, the price rounds are there. And that's typically when you want to be at least $1 million in revenue. You want to have some good trajectory, a good growth, a good repeatable kind of customer that you're going after, because it's still early for the investors, even at a Series A. They still consider that pretty early stage, where they're still trying to figure out helping you find product market growth or fit, and helping you kind of find your growth mechanisms and how you're going to build those engines to like let this thing start to expand. And then the B's and the Series B's and C's, you're just like dumping the gasoline on the fire, right? But once you take the seed or the A, you have to kind of hit these milestones in a certain time frame, or all of a sudden you be kind of looked at as like maybe not a good investment for the firm, right? So where we were at, we were doing the Series A.
So does that mean you already had a seed round, or is that to do with sort of the size and the growth and the traction that you've had?
Size. No, we haven't had a seed round. I'm just, and this is a good note, actually. That's a great question, because I remember when we first sat down, we were like, hey, look, if we did ever need to take money, we should try to shoot for, let's go past the $1 million revenue mark, because that will open us up into the A's and B conversations with Series A, Series B. And what's interesting about that is you do have a little bit more of a, I mean, not like a ton, but like, when you go to the table, right, you can maybe have a little bit more leverage, as opposed to a seed. It's just like, hey, this is what we're going to give you. This is still. So if you, and we haven't given up anything on the seed round. There's no equity given out yet, right? So we hold it all. So going to the A with no funding, we own all of it. And then we don't have investors that we have to carry on or clean up a cap table or anything like that. It's appealing, right? So you hear about some of these stories where, some companies, I think like Bubble, for example, Bubble.io, they went bootstrap for a long time, like years and years, and then they raised a big round, right? And typically when you're doing that is you're de-risking yourself as a founder, right? You're taking money off the table, you're taking secondaries just to kind of, de-risk yourself.
Sorry for asking these questions, but I'm just trying to unpack some of the things or the terms that some people might not know. So what is secondary and how does that work?
It's just basically like when you raise that round, let's say you raise, $50 million or something in a B or something like that, you could, offer up some of your equity to sell in the second, and then you get paid for that, right? You're selling your equity in that round just to de-risk and take some money off the table, which I think is smart for founders to do.
So JR, why was it sort of appealing for you to explore this route of fundraising instead of just staying focused on bootstrapping like you initially set out to do?
That's a good question. I think that was a conversation that me and my co-founders had where there was a few moments where we did kind of stop and say, well, hold on a second. Why are we doing this? Like we've said we didn't want to do this. We said we didn't want this type of company. We said we didn't, but there is a sense of validation that comes with that, interest, right? That kind of makes you feel, I'm just being honest, right? Like it can make you feel like you're a shiny object to someone, right? Like you're interesting to someone, that brings you validation and excitement, right? And so you can get caught up in that. And I think we did, for sure.
I feel like from an outsider, raising VC sort of expands the opportunity that you have. The reason you've invested back into the business thus far is you can feel the momentum with Lemon Squeezy. And a lot of the folks I see that have bootstrapped to a point and then raised have said it's because it's too big an opportunity to turn down and they just want to grow this thing further. You can do it bootstrap, but it's just slower and harder to do.
And we had that same thing. There was a sense of like, responsibility almost too, where it was like the type of business we run, we are responsible for helping these software companies and creators and indie hackers like be successful with, you know what I mean? And we are facilitating like a pretty, in our opinion, like a pretty substantial part of their business, right? And so not only was it about the growth, but it was just like that side of it was exciting too. And then obviously the connections that you can get and things. And here's the thing. Just because we didn't take it doesn't mean we can't go back and do it again. I had some friends that, they have raised close to $500 million, and I spoke to both of them, and they've been on the journey for like a decade, and that just said, why would you do this right now? That was the conversation, honestly, that changed everything. Why would you do this? You don't need it. You can operate without this. I think that we are enjoying the ride. I think that's kind of what it came down to, is like, hey, let's enjoy this. Let's not be in a rush. Let's not ruin a good thing we have for a short-term kind of thing. Let's see how far we can take this. Let's see actually what happens with the, economy before we do anything like this, right?
Yeah, there's definitely something to be said about how challenging the market is right now, and now really not being a great time to do this. You say you're enjoying the ride, but are you? It sounds very stressful, JR.
I actually am. I think it's good. I mean, I think growing pains are growing pains. Like, even if we took the money or not, right? I think people always think that, like, man, as soon as we hit 10,000 MRR, as soon as we hit 100,000 MRR, as soon as we hit 1 million MRR, everything's going to change. It doesn't change. The problems are still there. They're just different problems. I always say that. And I just know that from like previous experience. And even this one, like we've reached a lot of those milestones and the problems still exist. They're just different. And so whether we have money can solve some problems, but I think that we're kind of enjoying the freedom of not having to be held to some crazy milestones right now, and just kind of leaning into the customers and what they need and what they want. I think we're enjoying that. That's what I like right now. I can talk to people in Slack, and yeah, it's different.
Yeah, fair enough. And how involved were the other founders and partners of Lemon Squeezy at this point in the process? And let's keep the timeline moving. What else happened?
Okay. So the founders definitely were involved. I mean, I was the most, just as the CEO, just out there trying to do that. I felt like that was kind of my job, was to tell the story, get people excited about what we're doing, and, convince someone to write us a check for 10, 12, $15 million, right? Like, that was kind of my job. And so time frame. So typically, like, once you get into some partners, you can kind of start this cycle where you get your pitch deck ready, right? Our pitch deck was, I think it was 9 to 10 slides. We led with the team, the story about the team. Then we go right into like the problem, and then we go into like the solution. Then we went into like a lot of the traction, like what was the traction, what was happening, time frame of that, what caused the traction to take off, what use cases, that was big. Like who are we serving? The market size and competitors is it's interesting. And then we had a slide that was more about like, this is what we'll actually do with the money. And then this is how much, this is the ask, right? You ended with the ask. So yeah, so we kind of get that, that's where Orman and Liam got involved. And from a design perspective, we got all the content ready and they laid it out. And if you can imagine what anything on Lemon Squeezy looked like, you can imagine this deck looked absolutely beautiful. Every time I got on a call, they were just like, wow, your guys' branding is unreal. And that set us apart. I think spending time on the deck really made a difference. It's just the way it looked and felt and the story that was told. And I did a lot of rehearsing, a lot of practice pitches, dry run pitches, things like that to get comfortable with it. I could literally go through the pitch deck right here without the deck in front of me. That's how much I did it. Okay, so then the calls come in, the meeting set up, and I would just say this. You want to time box this, first of all, if you're going to do this. So you want to say, we got 4 weeks, we got 6 weeks, we got 8 weeks, whatever it is that you feel like you can do this in. The reason for that is, you don't want to get caught up in this process for too long. And you also want to set the expectations of the investors, and also for the team, you want to kind of get back to business because you can get kind of lost in this. And that, admittedly, that happened to me. I mean, I got pretty sucked into this. I mean, I was on a plane flying to San Francisco doing live pitches in person, and that's usually what it takes to kind of go get the term sheets. But to start in terms of process, you typically have the intro meetings, right? And I will say this, the investor community is very connected, right? There's telegrams and WhatsApp groups that they're all, as soon as this deal starts to go around, right? And you'll just start getting emails like, hey, I heard you're raising. I heard you're raising. Can we talk? And because a lot of them like to kind of piggyback off each other. And then typically they're looking for, whenever someone gets the leads with the sheet, then they kind of hear that, and then you go around and you kind of shop your deal. I wasn't as good as that just because it felt a little like crummy for me to do that. I wanted to find someone that actually cared about the business and what we were trying to do, as opposed to getting the best deal. The partner in the firm was more important to me than, getting the best terms, just because we didn't have anything to worry about in terms of a cap table. So March, all the pitches happen. And then, within probably 3 to 4 weeks, I was on a plane to San Francisco. In San Francisco, was there for like 3 days, did all the in-person partner pitches. That's a key word, right? That's a big key word, because what happens is you get into typically an associate. The associate goes and takes it to the investment team every Monday or Thursday when they have it. And then one of the partners gets involved. That's like in this space, like we were in fintech, right? So the fintech partner reaches out. They vet you, and then you kind of find this partner that's sponsoring your deal, right? And then they take you and they get you in front of all their partners, and they try and get this deal pitched to see if the whole firm can back it, right? So that's kind of like, that might sound simple, but when you're going into it and you don't understand that that's how it works, you know what I mean? You have to know who you're speaking to and what you're trying to do, because that sponsor partner is, there was a lot of them where like we would go back and forth with the pitch deck and just, I want you to talk on this more. I want you to speak on this more. I think this is interesting. I think this will help, right? They're trying to help you look the best in that meeting. And you want to get to those partner meetings. Those are the meetings where the decision is typically made about what are we going to do next with this deal.
So at this point, did you have one partner or firm in mind of who you specifically wanted to work with? You mentioned earlier about it being a little bit of a game, and sometimes you play these firms against each other. So how are you approaching this?
So my thing up front was very much around, I wanted to know people that knew our space. Payments was important to me. Someone that had that background, someone that had connections to Visa, someone that has connections to Stripe, someone that has, you know what I mean? Like just different things like that I think could help the business. That was super valuable to me. Also, someone that had been a operator or a founder before. I just didn't want like a spreadsheet kind of like partner, right? Like someone that's just like, the numbers look good. It's like, well, okay, but there's magic to how some of this works, right? With the brand, with the customer acquisition, it's not always just spreadsheets and numbers. So I wanted someone that I could yin and yang with. When the rubber hit the road or when things got tough, we kind of could work through problems and figure out, how do we do this? How do we attack this? And then obviously, like I would say the brand name was like kind of like in there, but it was towards the end of what I really cared about, because it does help from a recruiting perspective. It, like, don't get me wrong. Like there was times where I was just like ready to write that tweet. That was just like, we just raised this much money. We're worth this, and we're backed by boom. You know what I mean? Like some big name. And I would say the last thing is, when we were carving out the round, you can decide, right? With an A, for example, if you want to raise 12 million, go get 10 million from your lead investor. And you say to them, the other two, I'd like to round out with some strategics, right? Like I want someone over here that runs this business that I really, really appreciate. I love him as a founder. I think he'd be great to have in. I want to have this guy that's from Visa to come in. I want this guy right? And then that kind of sets up your board a little bit. And there's things you can do with your board. And there's all those things to consider that kind of come to life in that term sheet that you really have to kind of have to think about.
Were there any things that caught you out in the process, like a quirk you didn't know about, and how did you address it?
Well, I didn't really think about, this is one thing. Typically, like even when I remember when I walked into like A16Z, they were like, I was there for my pitch and they're like, where's your founders? Like, I'm like, it's just me. And they're like, oh, okay. Like, I just didn't, Orman is from London and Gilbert's from Scotland, right? So I'm in Utah, so it's an 1.5, 2-hour flight to San Francisco. So trying to get them to fly out here on a however long of a flight, right? So that was kind of scary a little bit, in the sense of like, I'm just trucking it along by myself, just going in all these buildings and pitching people by myself with like a room full of really high level people, right? And so I guess just something to think about if you're going to go do that. Like if, is your founder on board with you to come with you, and can you guys, it is nice to have a little bit of a wingman, right?
Yeah, you can kind of like bounce off each other. One person can answer one question, you can answer the other, but it feels like you were very much taking the brunt of it.
Yeah, I was like a comedian on stand-up, just like trying to keep the whole room excited about what I'm talking about, And then there's different questions, like, and what was interesting is obviously you're not going to get yeses from everyone. We had some no's, but some of the no's were like, someone would be like, I don't think the market's big enough. And then someone would be like, I don't think that you have this figured out. I don't think you have, and it was just like, they were all different. And so it is what it is. Like there's no hard feelings. I actually really liked a lot of the firms. I actually love to stay connected with them, and some, a lot of them I still am. And so, we'll send each other things back and forth. And ultimately it was like a really good process. I think one of the things when you asked me like that kind of like I didn't think about was, it kind of brought me back to when my old experience before I resigned from when I was like that executive life, where all the numbers and the spreadsheets and understanding every little thing about the business and getting it to that point where it's attractive, right? Like as a founder, when you're trying to get to $1 million or $2 million or $5 million in revenue, I would say that you're typically, as the founder, you're doing a lot of the things with your team, right? Like you're out there just kind of doing the sales, you're doing everything you can to get to that point. And a lot of the things like compliance and finance and accounting and taxes, you know what I mean? You're not really thinking about those things. And so you have to be investable, right? And you have to have all those ducks in a row. And I think that helped us get cleaned up, right? In terms of like making sure we were a turnkey kind of investment, right? For someone. And we could always be better for sure. But I do think that like we were maybe a little bit not ready, and we had to play some catch up there to like get ready for that, because we were just, like you're just flying by the seat of your pants, just trying to make this whole thing work.
Yeah, dude, I think a lot of founders aren't as clued up on the numbers as they could be. I came to this realization actually when I was reading Rob Walling's new book. It's called The SaaS Playbook. He had an entire chapter on metrics, and this just made me realize how far behind I am in terms of knowing my metrics. Do you think you're in a better position now you've got a stronger hold on your numbers?
Oh yeah. I mean, yeah, we use Retool, and we have so many like usage analytics. We have cohort analysis, retention analysis. We have, growth metrics. We have, just like even like our P&L is broken down by ledger versus like the payout cycles versus like, and a lot of it is, it's interesting things too with the cohort analysis, for example, because the Gumroad migration thing was a big one. Like how much of that accounted for the growth versus the other stuff that you were doing? Is this going to be a consistent thing, right? Will this growth keep up? That was a big one. So we needed to like break that down. And also too, like it's probably hard to remember, but OpenAI released like kind of their big thing earlier this year, right? So AI tools I remember like it was crazy. It was like, we track things by gross merchandise volume, GMV, the amount of revenue, payments processing. So that was like a cool statistic that I found within the numbers that I could lead in some of those meetings, was like, this is the amount of our GMV that's being, driven by AI tools and, things like that. And so, yeah, to answer your question, like I actually absolutely think we're in a better place. And I think it's something that we keep up to date, which is really, really good. But, for us, we're at a point now where I like I just said, I think getting to 1 million to 5 million, you could do a lot of the things with a small team, with maybe your processes aren't completely tightened up. The founder, the CEO is doing a lot of the things. When you want to take it to the $5 to $10 million thing, right? Now processes become really important. Putting functions in place, putting leaders in place of those functions, and getting everything kind of dialed, I think is kind of what we're trying to do.
Talking of how much money you wanted to raise and the valuation, who comes up with that number? Is that you? Is that the investors, or is it a collaborative thing?
Yeah, it's collaborative. I think, you can come out there and you can ask for whatever you want to. I mean, I could ask for 50 million bucks, you know what I mean? But they're going to tell me, like, typically in the VC world, they there's a range that's going around. Like, this is typically the revenue we like to see, and this is about the size of the checks. And it depends on you as a team, how much dilution you want and how much money you think you need, and what will you do with that money? And do you need to invest it in compliance? Do you need to invest it in sales? Do you need to invest it in engineering? Like, where is this money going? That really dictates. Because I do think that, you don't want to take too little, but you also don't want to take too much, right? And then you have a valuation you're trying to chase for the next round, which can kind of put you in a bad spot. And so I think as you get into it outside of the seed, I think it's all about your revenue and kind of what you're going to do with the money. And I also think too, the valuations are different now. Like I said, during COVID, they've come back down to more of the 2017 kind of realm, 18 realm, which I think is good. I think that's a lot better. So, and then the term sheet typically comes with, they do a pre-money valuation. They do that. They put that in there, what they think, you're worth. And then here's what we're going to put in. And based off that investment, here's the post-money valuation that you guys will be worth, because you're diluted at X, right? So you're getting 10 million bucks and your valuation's 50 million, right?
So JR, is there anything else you wanted to fill in terms of the process, or should we sort of move on to your decision to turn the funding down?
No. I think people can kind of follow up with questions if they have to, and I'd love to answer them. We can talk through DMs or whatever. I'll help you out. So,
all right. Well, let's get into the real meat of this. Did you have term sheets in hand, and why did you change your heart after investing all of this time and effort going down this route?
Yeah, we had term sheets. It became very real at that point, but along the way, we were trying to decide, what do we want to do, right? Like we got into this, we had a lot of interest, we got kind of sucked into this cycle, and we constantly were having conversations about the pros, the cons, why take it, why now, could we wait, will that be okay? And I also think like I owe a lot to like just like friends that had taken money and their experience and what happened to them. And there's horror stories, there's good stories, there's, you know what I mean? But I do think that it is one of those things for us where if we were a company that was bleeding money, or if we had, within 3 months, like no one's gonna be able to work here anymore. You know what I mean? But fortunately, we were in a position to where we didn't need the money. And I think that's ultimately why we were able to have the luxury of making the decision to not take it and hold off, right? And figure out, what does this grow into? How far can we take this by ourselves? And also too, like it was, I don't know, I really, really want to try and hold that narrative, because I think it forces us to be really close to our customers. Like we are fully reliant on them to fund us. Like you know what I mean? We cannot screw up. We have to, and I'm not saying we're perfect. Like there's things that we can be better on. The team is smaller by design to make sure that we stay profitable and self-sufficient. And there's cons to not taking the money for sure, right? It's not like it's all great that we didn't take this money. Like there's pros and cons to both. I'm sure you can like sit there and think about the pros and the cons, right? Like, so I think as a founder, you kind of have to ask yourself like what it is that you want and what is it that you have the luxury of doing. If you can run the business on your own, I think you should take it as far as you can. And I should have asked some of the guys that I asked advice for that had taken different paths. I talked to some people that went from seed, pre-seed, seed, down round, A, B, C, D. Someone that went all the way to a B. I've had gone to someone that went all the way bootstrapped and then raised private equity. I'm talking like hundreds of millions of dollars, right? Like I talked to the whole gambit and got different perspectives. And it's pretty eye-opening when you talk to the founders, right? The VCs are going to tell you like, you can grow faster. You can do these things, but it does come at a cost, right? So where for us right now, think about James, there's three of us, like 3 founders, the team is small. Like if we have an outcome, even if the size isn't like what you normally see on like a TechCrunch article where it's like they sold for $6 billion or something, like just tens of millions will change a lot of people's lives on the team, right? And obviously, I think for us, it's, we haven't even thought really about that a lot. It's more about how can we get to like 2030? You know what I mean? Like that sounds weird to talk like that, but that's, what can we do in 7 years? What can we do in 6 years? So those are the conversations that we're having now. So, and I think that's kind of like kept us excited that we haven't taken it, right? So, but the door is always open. We can take it again if we want to open that fund rounding back up. And so,
I definitely hadn't considered that too much. I thought it was more of a cut and dry decision. You either raise or you don't raise. You've chosen your route and you go down it. Because actually, if you had a raise, there's no real way back from there. Whereas here, you've got the opportunity to keep going the way you're going, and you can still choose both routes. And you've chosen the one that is best for you now. And I think that's the beauty of being a founder and making these decisions. But yeah, VC isn't something you can really come back from.
Exactly. And again, it's different for everyone, but it's something that we chose, and I think hopefully so far so good, but we'll see kind of how it progresses. But I think right now we're still a little bit in the phase of growing pains. I think that the team, we've really tried to kind of hire as we need, and I've always tried to follow that thing of hire when it hurts, right? So we don't have too much like weight that we don't need on the boat, you know what I mean? And keep it speedy and keep it quick. And the process, it's a faster turnaround that when someone's reaching out for someone, like everybody kind of is in the loop. And I just think we can move a lot faster right now. And so I don't know how much longer I'll be able to hang on to that, but it's been good so far. And I think what we're focused on at the moment is it's October 31st. So Halloween, boo. So it's we've got 2 months left, right, of 2023. So it's like end the year strong. Quality of life improvements is kind of like where we're focused. We've got some huge stuff coming in 2024 about to announce. So some things around pricing to kind of help that. Some things around a Lemon Squeezy marketplace, which we're super excited about. That's going to be a pretty big deal. And so we're just kind of focused on that. I think we're just kind of rolling in there with like we're gonna open up 2024 with some big punches. I think that'll get people pretty excited. So, but yeah, in the meantime, we're moving towards like processes and things like that for the teams, right? Like functional pieces, sales, marketing. Those are the things we'll kind of start building in 2024, getting us to that next level.
Cool. Well, JR, it's been great to catch up. Thank you for agreeing to bring the pod back. I think a lot of people are going to find these conversations very valuable. I know I've certainly learned a lot today about the fundraising process. Is there anything you want to add before we wrap up? Maybe I can just quickly highlight like fundraising as a startup, right? Don't feel like just because you didn't raise now or you don't get the deal now, you can always do it later. Do I need it? Well, should I take it? Should I do it? It all depends, right? It depends on how much money you have, how much runway you have, what type of industry you're in. Are you even a fundable company, a fundable business? Get real with yourself. And then also think about what you and your co-founders and your team wants in terms of like a lifestyle and what you want out of your business, right? So there's just a lot of things to kind of deal with there. And I just kind of want to open up, my Twitter DMs or Slack or whatever, right? I'm happy to chat through any of that. So. Very well said. Well, let's wrap up here and we'll be back next week for an episode all about shipping at Lemon Squeezy. Thank you for listening to this episode of Make Lemonade. If you enjoyed the conversation, make sure you hit subscribe or follow button on your podcast player of choice. And of course, we always appreciate reviews. If you want to check out the product Lemon Squeezy, you can do. Links are in the show notes or head to lemonsqueezy.com. See you next week. Okay, all right.